And we are mimicking exactly what we did in the 70s. And remember what happened then. Not a good time. Not a good time at all. So I would be very conscious, very, very self-conscious as to what what this is going to mean, because this could be a major issue. This could be a humongous major issue. Why? Well, because we are potentially looking at stagflation. We might be looking at stagflation. How do we get there? Well, because there's three things happening at the same time. The first one is obviously you have the economy that is slowing down. That's one. But then I could make the point that, well, the economy is slowing down by having jobs. We're creating less jobs. So that's one thing you could say. That's bad. Yeah, okay. Instead of expecting 150,000 jobs, we should be expecting maybe 40, 50, 60,000 jobs a month. But at the same time, since inflation is going up a bit, well, maybe they'll balance each other out. Okay. That's the one thing you need to think about. The second thing is the fact that there's drama at the Fed today. And there's drama at the Fed. Essentially what we have is we have a Fed that is very contentious. You're going to have dissent at the Fed at the next Fed meeting. The target for inflation rate is 2%, and right now, it's around 2.9%. So we're not nowhere near there. Okay. Now, of course, we could say, well, maybe the 2% is too low. That's a possibility as well. Okay. So what does it mean? It means that we have dissent at the Fed. As you know, out of the 7 Fed governors, 3 are more or less have been appointed by Trump. So, we're going to assume that we're going to have lower rates. So that's good. We got 3 of them with lower rates. But one thing we need to realize is that we also have 4 others. One of them is Lisa Cook, pretty upset at the president for obvious reason. We have the Fed governor, the Fed Powell, obviously also very upset at the president. That's 2. And then we have 2 others that always, voted for basically, keeping rate steady. So it's 4 versus 3. But the market is expecting right now a decrease, which we better get it. Otherwise, you're going to have a market meltdown. So you're going to get a 25 basis points. And the reason you're getting a 25 basis points today is because a month ago or two, Powell indicated that he would be focusing more on the weakened employment than the rising inflation. That's basically what he said. That's what he decided to do. So everyone is assuming that we are going to see lower rates. But at the same time, I have to say that we are seeing higher rates. Inflation is not under control. And because of what's going on with the tariff, we might be seeing the beginning of inflation permeating through the system. I will tell you, for example, that if you go to Costco, you will see that the amount of money you pay for a pound of ribeye now is $22 a pound. It used to be $17 not too long ago. Coffee is more expensive. And now, is this a one-shot deal? And that's the question. But the economy is doing fine, though. Don't read too much into it one way or the other. Because the economy right now is doing fine. In fact, we recently had some numbers coming out of retail sales, and retail sales are telling you that basically people are buying. The economy is still strong. In fact, we're going to have some Fed surveys, and you're going to hear what the Fed said today. But the Fed basically is expecting 3.3% growth in GDP. So they're all expecting growth. Well, hold on a second, because if you're expecting growth and you're lowering rates, you know what that's going to do, right? That's going to pump up the volume even more, and therefore pushing inflation higher. And again, back to my biggest black swan, my biggest concern is the fact that we might actually see a redo of the 70s. And at the end of the day, as you could see, 2% is not such a big amount of rate. If you compare to the rest of the world, We even at 2.5, even 3% would be okay. So looking for 2%, it might be a bit too much. So let's talk about what happened in the 70s. So I want you to make sure you understand what went on there, because that is actually a pretty big deal, especially in that time. We had a huge amount of inflation, and that was a problem. So basically, in the 70s and the 80s, there was a stagflation period. They lost total control over inflation. And the CPI at that time was as high as 10% by late 1970. So there were two major oil shocks in 1973 and 1979, plus productivity slowdown. So that's what caused the thing at the beginning. And high unemployment was reached, 10% in the early 80s. And the reason we had that is because Volcker came in and he raised rates to fight inflation. And price rose rapidly and employment rose. So when you look at what's going on right now, the current situation is that you have inflation is elevated but moderating, 2.9%, 3% core, and the growth is still positive, also slowing down. Unemployment ticking up from the lows, but still 4 to 5%, much lower than stagflation. And policy-wise, the Fed rates above 5%, but inflation expectation remain anchored near 2 to 3%. So they want to keep rates down. Shocks, well, tariffs, maybe, supply chain realignment, and geopolitical tension, though not as extreme as a 1970 oil shock. So you have the same situation that you had in the 70s. Maybe we could say tariffs is a shock, and the supply chain realignment, what's going on with Russia and the Middle East, but it's adding cost pressures. But frankly, it never really impacted anything. It's not as bad as the oil shocks of the 70s. Basically, what happened, the oil shock is it decided to increase, the oil producing country in the Middle East decided to increase the price of oil. So there was a shock. Okay. And so are there risk of stagflation reemerging? Well, if you have persistent supply shocks, that's going to be a problem. If you have energy spikes, renewed shipping crisis, maybe you could have a Red Sea, the tariffs, the blockades. You could have a climate shocks, policy mistakes, if the Fed eases too soon or the Fed stays too tight for too long. But at the end of the day, it's probably less than likely than what happened in the 1980s, because inflation expectations today remain well anchored. In the 70s, they spiraled upward. It just went straight up. Energy mix is more diverse. We have shale, we have renewable, we have less OPEC dependency. So right now, the bottom line is the risk of the 80s style stagflation isn't zero, but it's much lower than back then. What is more likely is a period of sluggish growth and above target inflation. Now, it's important to get it right. It's important for you to get it right because the market is going up. You don't want to miss out on the market either. So you have to be very careful that you understand exactly what happened. Now, we're talking about this target that the Fed has, which is 2%, which might be a bit too low. Why did the Fed choose 2%? Well, it's a low, stable rate and anchors expectation. It prevents runaway inflation. It avoids deflation. 2% provides a small buffer above zero, reducing the risk of falling into deflation like we have in China. Many major central banks also targets 2%. Of course, there are those that say that maybe 2% might be a bit too low. And why is that? Well, zero lower bound problem. With only 2% inflation, nominal interest rates are often not much higher. In recession, this gives the Fed limited room to cut before hitting zero. Right? If you have a problem and you want to cut rates and you're already too low, maybe a higher target would give more space to simulate the economy in downturns. That is important. Aging population, globalization, and tech advancement may keep inflation naturally lower. Some argue this means aiming at just 2% forces unnecessary tightness. There's no reason. It may actually go down naturally on its own. Worker resist nominal wage cuts. Slightly higher inflation allows real wages to adjust more flexibly without painful visible pay cuts. Now, the argument for keeping the 2% is the Fed has spent decades anchoring inflation expectation at 2%. Moving this goalpost risks losing credibility. You don't want to lose that either. High expectations steadily erodes consumer purchasing power. For fixed income households, targeting higher inflation is politically and socially difficult. So the 2% itself is not wrong, right? But many argue it may be too low given repeated encounters with near zero interest rate. A modestly higher target could reduce recession risk, but changing it would be a major credibility gamble for the Fed. And the reason what they're saying is, if you want to lower the rates to keep it at 2%, the only way for you to lower the rates, inflation rate, is that you have to raise interest rates. But if you raise, right, you could put the country in a recession as well. So maybe that 2% is too stiff, too strong, too low. And then maybe if you just keep it higher, you won't be so pressured in raising rates all the time and be more focused on employment. And that's very important because this is going to be a problem because think of it this way: if you were to compare what's going on overseas, right? Because we're saying 2%, we got to lower the rate. Well, United States at 2.9% right now, Canada 1.9. China minus 0.4. They actually have deflation, believe it or not. So they have an opposite problem. India is 5%. Mexico is 4.7%. And the euro rate is 2%. So there is no reason to maybe get ourselves all strung up on that 2% because, frankly, even at 2.9%, it will be below India, below Mexico. The euro area is 2%. So it's not 2.5% maybe as opposed to 2%. The U.S. inflation remains elevated above many advanced peers like Canada and the euro, which are closer to slightly above central bank targets. China experiencing deflationary pressure, and that's a whole deflation, right? Is deflation good? No, deflation is not good. And the reason it's not good, like what's happening with China, is you because you're producing so much and you can't sell it, so now you cannot sell. You're losing money basically. You cannot. You think you could sell it for $10 and they're not going to buy it for 10, so you go 9, 8, 7. Why? Because in China the way they're doing business is the government gets involved, right? And they say, hey, let's focus on real estate. So the government goes out, make huge amount of loans to everyone, and all the loans go out to the people and the companies, and they borrow money and they build houses, and then the government goes around to the people and say, you want to buy houses? Let me lend you money. And so artificially you're bringing everybody prices, and you're building and building and building, and then the demand goes down. And what do? Because it's artificially propped up. And then what you have to do is you have to, that's why they had the real estate crash. Prices just collapsed in China. And China produces almost 70-80% of the goods of the world, the entire world. So it's got to go somewhere. And that's why this idea of this negotiation is going on right now with the U.S. because they want the U.S. to buy their stuff. Otherwise, they're going to sell to Europe. They got to sell it somewhere, and that's not a good thing either because now, you're selling all these items that nobody wants because they got too much of it. So you got to lower the prices. And so that 2% in the U.S. might be a bit too strong right now. But I mean, obviously, what's going on today at the Fed is this drama, right? The drama that is going on because you've got two people that are upset is to say the least at the U.S. government, Trump in particular. You got three guys that just came in. Well, one new guy that just came in, and two others, right? But with these people coming in, they obviously want to show off to the new boss. What are they going to do? They're going to do 25 bips, obviously, because the boss wanted, I mean, the Fed wanted 25, the Fed chair talk about lower rates already. Maybe they may want 50. So what are we doing? Is this a beauty contest in front of the president so that you could become the next Fed chair? I mean, they could make a case. You can make a case that you should lower the rates. I mean, if you look at the latest employment numbers, they were pretty dim. In fact, for June, it was minus 12,000, meaning that we actually lost jobs in June. That's not good. So that means there is an employment problem. So therefore, because of that, you should lower the rates. But at the same time, when you're looking at what's going on with the GDP, which has +3, and in fact, expectation from the Fed is going to be almost 3.3%, they're expecting the economy to go up. Well, if the economy is going up, then you don't need to touch rates. It's fine the way it is. The problem, the market is already expecting rates to go down. So if you don't have a 25 basis points cuts today, the market is going to collapse. And if you have 50 basis point cuts, aren't we at all-time high? Wouldn't the rate cuts be priced in? Right now it is at 25 basis points. But if you get 50 bips, the issue you're going to have is, now, are you getting the 50 bips because Whalen, for example, who is one of the Fed governors, who wants to be the next Fed chair, might want to do it to show Trump that he really wants to, play ball. Although you could always make a case for 50 bips at the end of the day. But the market might view it as, if they view it as that, that's okay. But if they think that, okay, so we really have an employment problem then, so we're heading to a recession, then you're going to have a market collapse. Right. So what's going to happen today is everyone is going to be looking very carefully as to what the Fed chair is going to say. Because if he implies, and this is, and I want my subscribers and my members to understand, this is very tricky, because if he gives indication that we're going to have a potential recession problem, then they're not going to look at the 25 bips or the 50 bips as just, we're just trying to get to 2%, but they're going to say, well, then we have a problem. And it's going to be very difficult to discern that, because these people today, when they're going to meet, there's going to be dissent. Probably somebody's going to mention 50 bips in there. And it's not a normal, it is not a normal Fed meeting today, because you have dissent within the Fed. You've got some Trump people in there. And I mean Trump people, they just brought this new guy that replaced the lady that left, the governor that left in July. She just left. She just said, I don't want to vote. I don't want to do anything. I don't want to, I just want to go back teaching. And that's replaced him last night. Last night they replaced him. The Senate voted to bring him in, and he said, no, I am totally impartial. I will not do anything. Okay. Do you believe that? That's a question, right? So who do we have here? Well, we have, obviously you've got Powell. Now, he was nominated by Trump. That is true, but we shouldn't say he was nominated by Trump. What you should say is that he was nominated during the Trump presidency, because Mnuchin was the one that pushed for him, and Mnuchin is gone. It was a disappointment. So when people say, well, what is Trump complaining? He brought the guy in. Not really. He brought him in, right, because of what happened, because Mnuchin told him. They could just leave rates, the way they are. No, they can't do that, because they're expecting a lower rates. And there's a tremendous amount of pressure within the Fed to lower rates from the government. Now, what you have also, you have Jefferson, and you have Barr, and you have Lisa Cook, right? All three have been appointed by Biden. Now, Barr, fine, Biden appointee. Lisa Cook, there's a whole story around her. Obviously, as you heard, they want her out. And she got yesterday reprieve to actually sit on the board today and actually vote as well. Unprecedented pressure on the Fed. Now, of course, you could make the case of, do we really need the Fed, right? You have to understand that historically, if you the mandate of the Fed originally in the 1900s, 1919, I believe, was just to monitor the money supply. The Fed, the U.S. was a bunch of banks all over the United States that were there to promote the agriculture, the farming community, right? So they have enough money to produce, and when they produce, they repay. But a lot of banks went bankrupt at that time, so that's why they kind of created the Fed to help for the flow of the money supply. This whole idea of going after rates and going after employment, that wasn't in the original mandate of the Fed. And frankly, if you speak to Milton Friedman and a bunch of economists, they don't believe that you should have a central bank. Yeah, you shouldn't have someone that's in there, poking around at rates and trying to dictate the policies that's going to go direct the economy and employment. That is not. It's not a universally accepted principle. It's done. It's been there, and they're doing it. It doesn't mean that there are no other option. Milton Friedman, greatest economist, basically said that, you know what the Fed should do is they should just manage the money supply. That's what they should be doing. I mean, don't forget, they messed up 2008 very badly, the Fed, right? They missed completely the, in 2021, when there was a huge amount of inflation, they just sat there and figured, well, we thought it would be transitionary. And this idea that the Fed is independent, well, I mean, depends which side you're sitting in, but I could tell you for a fact, and this is where this 1970, 1980 situation with the Fed and the president, at that time, Nixon was basically he was really controlling Arthur Burns. And so the governor, the president basically was trying to dictate what the Fed was going to do, and they did. And unfortunately, it didn't work out so well because they decided to lower the rates. And look what happened. Huge amount of inflation. Exactly. So not necessarily a good thing that happened at that time. So at the end of the day, what we're saying is we're going to, we'll see what happens today. But the idea is to say that you're going to have your rate cut. You're going to have potentially some good news in the stock market. But what you have to watch out for, and this is my black swan warning of the day, you need to be careful that you're not recreating a 1970, 1980 type of situation. That's what you need to worry about. And insofar, inflation is slightly going back up. The economy is is still strong. You could say you have low employment, so that's going to help a low job creation. But still, that could be an ongoing issue. So let's watch, and more importantly, make sure you protect your portfolio going forward, because if this goes wrong, then you got a big trouble on your hands next year. And right now, you could hedge your portfolio in a very, very cheap